earlier today, we looked at where interest rates were a year ago. And if we use the US 10-year T-bond as the reference point for the world, it was 2% last Labor Day. It's close to 3% today. We've had a very big adjustment in interest rates very quietly over the last 12 months. So to us, the near-term need for another big adjustment isn't clear. There is, though, a longer-term upward pressure still in place on interest rates everywhere. It's called the real rate of interest. It's essentially the after-inflation payment for saving versus spending. Over long periods of time, a nominal or market interest rate is equal to something like a 2% real interest rate plus the inflation rate. Right now, that number is about 0.5%, a half of 1%. As the economy's been normalizing, we've moved from negative demands for real interest rates into a positive demand, but only to 0.5%. We need to push that up closer to 1.5% over some period of time. How long will that be? It's really a guess. Could be 3 years, could be 5 years, could be 10 years. But every point that we move from 0.5 to 2% in real interest rates is a reduction in the ultimate total return on a fixed income investment. So right now, to use the 10-year T-bond as the global reference point, you buy a bond, your coupon's about 3%. But your return will be reduced, we believe, in this ongoing adjustment in the real rate. So I think you'll earn something like 3% minus over a very, very long period of time. Low total returns, even negative total returns for a long period of time in most countries.